Welcome to the Passive Income Machine podcast, where we show you how to break free from the grind and achieve real financial freedom in 10 years or less. My name is Ryan D. Lee, and I've helped thousands turn income into cash flow, trade fake money for real assets, and take back control over their time, their wealth, and ultimately their life. Each week, you'll get strategy, tools, and mindset to build your own passive income machine. So my friends, sit back, relax, and enjoy today's episode. All right, my friends. Welcome back to the Passive Income Machine podcast. You are on the microphone today with me, Ryan Lee, and my new co-host, Scott Saunders. Scott, what's up, my man? Are you ready to go today?
Ryan, let's rock and roll. It's always fun to do these podcasts and so excited to dig in today. It's going to be a lot of fun.
I tell you what, as we were getting Scott on board, coming on full time with running this podcast with me and really being an optimal builder inside of the Money Mastery community, we were talking about, look, what is the thing that we help people do? And Scott, I think you and I, we get these questions all the time. What do you do? Because, most people, when they say they're in investing or they're in finance, everyone just has a natural default that they're in the stock market in some form or fashion. But, as we're getting ready to release the new book, I really think that what we do, it's tax strategy. Like everything that we do is tax strategy, and the umbrella of tax strategy then dictates how do we optimize taxes both now, but especially in the future. And once we have that lens in mind, we kind of choose where we put our money, how we invest, in what strategies we use based on how do we eliminate taxes as much as possible from our future. What are your thoughts on that? We do tax strategy versus investment strategy.
Yeah, well, investment strategy is a lot of times very myopic, right? It's in typically one approach, and it's looking at one thing. Tax strategy is more comprehensive, and it evolves over time. That's the beauty of it, is you got the tax code, which has all these opportunities, and sometimes when you're starting out, you can take advantage of a few strategies. And as you develop and as your system and your passive income machine grows and scales, it opens up and it unlocks brand new strategies that you can take advantage of. So tax strategy evolves, right? It's something that really grows over time. And, just for starters, Ryan, I think we should kind of define and just step back a second. When people think of tax strategy, that's kind of a new concept. So many people go, I've got a CPA. He's a CPA. He's been doing it for X number of years. And I don't think people really grasp that your CPA is what we call a tax preparer. They take your data from the year, they drop it into some tax forms, they add up all the numbers, and they keep you out of jail. They basically follow the rules and report the income that you had. That's kind of the role. How else would you kind of frame that? What does a tax preparer do?
Yeah, you know what? I'll tell you what. We're getting ready to go into football season, and although I don't watch a lot of sports, man, if I can sit down and watch a sport, I love watching football. I just love, especially college football. And when I think about football or really any sport, you've got a team, and on that team, you've got dynamic players, and you're looking for your strengths. Are you a defensive team? Are you an offensive team? Are you a passing team? Are you a rushing team? You want to play to your strengths, but the coach's job is to look forward and say, look, my job is to get us into the Super Bowl or get us into the championship game or whatever whatever they're trying to do. But then in order for that goal to happen, the head coach has to look ahead and say, who are we playing next week? How do we optimize our strengths, and what are the other team's strengths, and how do we match up? What do we need to do to be able to win every single game against teams that have a myriad of different strengths? That's how I look at tax strategy. Tax strategy is looking forward. It's understanding what the end outcome is, what the definitive goal is, and then optimizing our playbook today based on the way we make income, based on the investments that we have, based on the structure that we have, to minimize our taxes no matter what the IRS is throwing at us. And tax prep CPAs, they're kind of looking in the rearview mirror, right? They're looking at everything you've done. They're then taking your income and filling out the forms appropriately and telling the government, hey, here's how the money was made. Here's how much taxes are owed. I signed my name. Good to go. So a CPA and a tax strategist are two different things. That's kind of the way I look at it.
I think that's a great way to frame it. One's looking back at what you've already done and just reporting it. The other one's then looking at how do we take what you've got going on and optimize it for a specific outcome. And a great analogy to the football game, because it changes over time, right? Your strategy in the first quarter might be a little bit different than a few quarters in when you've got some challenges or you've lost a key player. You may have to adapt. And that's what you can do with the tax code. That's why I think it's so critical that as people get on the path of financial freedom, they understand that they've got all these opportunities in the code. And now they can kind of align how are they making income and set up the right structures to kind of optimize that now. And what's really neat that you brought up is you can optimize it going forward, right? I can be doing things today that will really make my strategy even better 2, 3, 4 years from now by redeploying and kind of reallocating. And that's the beauty of it. It's not a static thing doing tax strategy. It's kind of it's an evolving process.
Now, I love your thought process on this, Scott, because you actually talk about the tax code in a pretty unique way. And while you were talking there, I just chat GPT'd. I mean, it's crazy that we're doing a podcast now, and I can ask chat any question and get some feedback. But I just chat GPT'd. I wanted to know the specific number. So how many pages are in the tax code? And what chat says is there's 2,600 pages. If we just took it and printed at 2,600 pages, but behind those 2,600 pages, there's an additional 70,000 pages of regulations, interpretations, case law, things like that. But when we look at the tax code, right, that looks like it's pretty complex. It looks like it's pretty overwhelming. But you actually talk about the tax code. Those 2,600 pages are a good thing. Tell us your perspective when you think about and talk about the tax code.
Yeah, when I look at the code, if I were to pick up just a simple visual image, look at it as a treasure map. Rather than be something that's to be feared and intimidated by, it's something to kind of dig into and to start to unpack and to look at it. So when we look at the code, I would look at the first 15 or 20 or so pages. You've got some tables. They say you make X amount, pay such a percentage. And that's what a lot of people think of when they think of the code is I've got X amount of income. I'll take a couple deductions, maybe a charitable deduction, little donation to Goodwill, and maybe my mortgage and a few other things. And then I got leftover money. And then I'll look at where that matches on a table, and that's the percentage I write a check to Uncle Sam for. Nobody loves writing that check. What I look at are all the tax code that's behind that initial 15 to 20 pages. And then you go, what am I doing? What sort of activities are there? What incentives are in that code? And there are long-time incentives. There are new ones that come in as tax laws are modified. And I look at those incentives and go, there's this little thing over here where if I do such and such activity, I'll get a tax benefit. Maybe because Congress, in their wisdom, thought we want to encourage this activity, real estate development, or whatever it is that we're encouraging at the time. And then I can go, if I take my capital and I invested where that code says I get a benefit, I save money, and I also get this great benefit that the government wants to encourage. So in a way, we win as individuals, and the government gets the outcome, the economic outcome that they wanted all the way along. So in a weird way, we're almost partnering with the government and efficiently taking our capital and efficiently allocating it towards outcomes the government wants. And in exchange, the government goes, thank you very much. We're going to give you a big tax break. That's how I look at it. How do you look at it?
100%. And you were saying something right before we switched on the mic. I think a lot of people would say that you can't do that. That's illegal. That's not right. But there's precedent behind this. What does the judge, Leonard Hand, what does he say about the tax code?
One of my favorite quotes, Judge Leonard Hand from years ago said there are two different tax codes. There's one tax code for the uninformed, and there's another tax code for the informed.
Yeah.
And that really speaks to what we're talking about here is digging into, all the rest of the tax code. That's what he's referring to. And that was a quote he did many, many years ago. That's a quote that's been around for a long time. And it really reframes how you look at it. So as we're talking about financial freedom and doing it, one of the key things is getting a grip on taxes and starting to learn how to optimize, because it's very hard if you're working really hard with income and paying a big percentage of away in taxes. It's really hard to move the needle a lot. And that, I think, is kind of something that people come into our community and they're like, wow, their eyes go as big as saucers when we start showing them some of these different ways that we can optimize and strategize.
I tell you what, that really is the key. I think today more than anything, financial freedom is a function of financial intelligence. The game of money has become so complicated. It used to be really easy. Go to work, get a pension, get Social Security, and then savings in a CD or a checking account with a high interest rate. That's just the buffer for the rest of time. But we've, as Americans, have been forced into becoming more financially educated. But that education has to be sought on your own, independently, because schools will never give it to you. Likely communities will never give it to you. And most people find themselves uneducated, ignorant to what the tax code is. And because of that ignorance, they either, they're afraid of it, or they go hire who they think is a perceived professional, a CPA. And again, this is the problem. A CPA is looking in the rearview mirror. No one's looking forward. So, Scott, when we talk about the tax code, I think it's important that we understand what we're trying to accomplish. There's really two things that we're trying to accomplish when we're financially planning holistically, right? There's the taxes that we pay on the income that's coming in, right? Whether we're a business owner, an entrepreneur, a W-2 employee, sole proprietor, whatever it is, we're paying taxes on the income that's coming in, and there needs to be a strategy around that. But I think what most people fail to look at is every dollar that you're saving for the future, that's delayed spending. That's all savings is. It's you want to spend money in the future. And if you're not careful, you're going to spend money at a high tax rate in the future without tax strategy. So when you look at the tax code globally to say, how do I optimize taxes on my active income and how do I minimize or eliminate them on my passive income, what are some tools and tactics that you've seen across the board? Hey, just sliding in here really quick. I hope you're loving the show and taking some serious notes, because everything you're learning right now leads directly to the How to Retire in 10 Years Summit. It's the event of the year. If you're ready to stop dreaming and start living financially free, we have early registration open right now with an exclusive bonus that is too good to pass up. So click the link in the description or just head over to retireintenyears.com and grab your spot, and let's make this year the year that everything changes. Now, back to the show.
Well, one thing I would tell you you don't want to do is what a lot of CPAs recommend, which is, hey, take advantage of a qualified plan, right? Get a little tax break today, and we're going to push that tax liability into the future. That would be kind of traditional advice. Put money in a plan like an IRA or a 401k. But that tax liability now is kicked into the future, into retirement years, when reality is we're not going to have necessarily as many things available to offset that liability. So it's kind of dangerous in a way to do that. So that would be the traditional approach.
Let me jump in on that and just get your opinion on this.
Yeah.
Why is that the most prevalent thing? You've had a 401k. I've had a 401k. I would venture to guess 80 to 90% of the people that have come into our community over the many, many years have had some form of tax-deferred money, IRAs, brokerage accounts, 401ks, whatever it is. Why is that the go-to number one piece of financial advice is take a deduction today and shift your tax liability to tomorrow?
I'd say two reasons. One, I think because I think Wall Street kind of encourages that. There's some benefits for the people that manage the money. And so you see that in magazines. This is what you're supposed to do. You read any financial publication and they're referencing things like 401ks and IRAs or Roth IRAs, all these different vehicles. That's what's being referred to. The other one is probably just laziness. It's really easy to say, hey, here's this thing here, check the box, max this out, and not really open up or unlock the door of some of the other opportunities. So I think some of it is just, it's easy. If I'm a tax planner, you're telling somebody very common advice. I can't think of many CPAs that don't cue that up as something to do. That's pretty standard, typical advice, regardless of what income you're at. Maximize that qualified account, take advantage of it. So I think it's just being a little lazy and not necessarily opening up opportunities. But again, is your tax preparer really the person that is supposed to open up those opportunities, or are we supposed to plan and read and study on the internet, develop our own financial education and learn what really works from people that are doing it? The big difference there.
It is a huge difference, and I also think it comes down to skin in the game, right? I mean, at the end of the day, your CPA, they have skin in the game to save you taxes today. That's what they're paid on. That's what they're incentivized on. They want to bring back a number and say, "Hey, Mr. Client or Mrs. Client, I took you from 24% bracket to a 22% bracket, or whatever that might be. I saved you X dollars in taxes, and the easiest, lowest hanging fruit that no one questions is defer your taxes in an IRA, and then we're kind of sold, and I don't know if people really think this through at one or two levels deeper. We're sold this idea that we're going to retire in a lower tax bracket. But when I think about retirement or when I think about financial freedom, most people, myself included, I don't dream of spending less money than I'm spending today. Yeah, maybe my kids are gone, but hopefully I got some grandkids, right? And I want to bring those grandkids at home, and I want to fly them out, and I want to do big family vacations, and I want to go travel the world. I want to spend more money differently than I'm spending today, but I want to spend just as much as I'm spending today, if not more. And that again doesn't even consider inflation. I don't know if it's even possible to retire in a lower tax bracket without retiring broker or with less income than you are today. I think that's one of the biggest misconceptions or second order consequences of deferring your taxes to the future. What are your thoughts on that?
I agree 100%. Most people don't think about it. I think it's one of those mantras that's repeated over so much that people just kind of accept it. Oh, I'll be in a lower tax bracket. But do we really want to have less money? Do we really want to have less resources to do the things we want to do, to have adventure and spend time with our family and friends? I don't think anybody really does, but they're taught that. So I think it's just a mantra that's just repeated and people kind of accept it. What is it? Is it Lennon or one of those guys that said if you repeat a lie over and over enough, it becomes a truth? And I think to some extent, some things that we hear from a financial perspective are repeated over and over, and we kind of just accept it as the status quo. And because everybody around us at our workplace is doing the same thing, we look to our left, we look to our right. Well, they're doing it, and I guess I'm doing it, so I'm on the same path with them, and I'm doing the right thing. And it takes a little bit of self-reflection to step back and really look at it and kind of run the numbers. That's what I love. Some of the things you do, some of the financial calculators that we have in the community, where people actually sit down and crunch the numbers. And boy, is that an eye-opening experience. You and I've seen that so many times where people put in their own numbers of what they're going to have in retirement. And it's pretty sobering for most everybody that does it.
So let's talk about this. Yesterday we had a conversation with someone in our community, high income earner, majority of the income coming from W-2, W-2 taxable events. But he's looking for ways to optimize his overall tax strategy. You have seen everything under the sun, from tax strategy on active to passive. You've participated, you've done most things that most people wouldn't even consider. You've done them. So when you're sitting down looking at someone's overall objective of lowering taxes on active income and minimizing or eliminating them on passive, kind of give us your playbook. What are some of the things that you look into? What are some of the things that you encourage? What are some of the things that you've done yourself?
Yeah, well, I'd say for starters, what you want to do is that W-2, that type of ordinary income, it's challenging. There's only so many things that you can do to shelter that. There are a few things you can do, but not a lot. What you want to start focusing on are probably two things. Number one, building some passive income like we do with turnkey real estate. Start acquiring some assets and begin building what I call a real estate business, right? It's actually a business of owning real estate. The other one, and this individual's doing it, it was really encouraging. This person had a fantastic structure and so many things going well, and they were really, I just put it, they were on the cusp of really getting over to that next level. But they had some different businesses, right? They'd started up a business here and there, and those businesses were very close to being profitable. When a business gets some profit, it unlocks a whole nother door of planning opportunities. Now you can take advantage of all sorts of strategies, things like paying your children with the business, right? So that's something where you're doing that. You can begin to shift what are called personal expenses and make them legitimate business deductions, things like computers we all use and the home internet and all these different things that we pretty much need to live and exist today. They can become a legitimate business expense. So growing the business side, that active income with your own business or a side hustle, that's always been a powerful tool in America. In fact, the code encourages business creation. So that's a really important one to do. And then on the passive side, the tax code really encourages real estate investment. You got write-offs for your mortgage interest, your property taxes, your insurance, your maintenance and expenses. You get this wonderful thing called depreciation, which is phenomenal. So depreciation, for those who don't know, you probably heard the term. You just take a building, so on a residential real estate, you take a building and you take the improved property, which is 80% of it normally, of the value, and you divide it by 27 and a half. And every year you're able to take that depreciation deduction every single year. But ironically, that building is going up in value over time. It may not in the first year, but over 5, 10 years, it'll go up. So I'm getting a tax benefit lowering my income. And at the same time, the asset I bought is actually going up in value. So you get, it's almost like double the benefit, right? The asset's going up, and yet I'm taking a tax incentive with depreciation. That is a huge tool. And today, right, in the code today, we just got a gift on July 4th with the new tax laws that passed that allow this thing called 100% bonus. And we won't go into the weeds of what that is, but that is a beautiful tax incentive for some people that qualify, where they can actually now front load that depreciation and pull it into this year, 2025, take it all now and use it to offset other types of income. And that is really going to be a huge incentive. In fact, I think investors that look for those types of strategies, everybody that I know, when that came out, they were smiling and grinning, going, wow, we've got something that really rewards us as real estate investors, and we're going to go into it, full speed ahead. And here's the beauty, Ryan, it's permanent. So for right now in the code, there's no sunset on that. Code will change. Some year it'll change, things will change. But for now, in the immediate time horizon, we can take advantage of this year after year. So we work with people and saying, hey, how can you maybe move over to a camp where you can take advantage of it? And there are ways over a few years that you can kind of move into that category. And that's the fun part about it, is now seeing that that's a tool available. And then we're going to take somebody's facts and circumstances and say, hey, can we reshuffle and reorient a few things and move you to where you could actually take advantage of 100% bonus depreciation?
I love this. And you actually, I want you to talk just a little bit about this, because yesterday when we were on this call with this individual, high income, W-2, right? He's doing everything he can to lower his tax rate and his, money out of pocket on his active income. But with W-2, there's not a ton, right? And so the business income that he's working on, that will lower his overall taxes paid. But one of the things that you brought up was moving what is usually a passive income deduction on real estate over to the active side. And you brought this up specifically for him, kind of in the world of Airbnb short-term rentals. Talk a little bit about this unique strategy and how you can play that either on the passive or the active side under the right conditions.
Yeah, so this strategy is phenomenal, Ryan. I love this. It's a great planning opportunity. It's what's called the short-term rental loophole. And I don't love the name, but here's what it is. You can buy a vacation home. So think of an Airbnb, something that you rent short-term. And that type of property, because of the way it's classified, it's got a unique classification. And so most people, to qualify for bonus depreciation, they have to put in all these hours, like 750 hours, and it's a big effort. It's a really heavy lift. With the short-term rental loophole, you only need to have 100 hours of managing that asset. So it's 100 hours, and then it's also more than anybody else. And where it's really kind of an attractive thing. In fact, I shared this with my brother last night. You can do it in the first year and manage the asset and qualify for the short-term rental loophole, take advantage of it. And if you decide, you're a married couple, that it was too much hassle, the next tax year you can hire a property manager. So you got the benefit in year one. And let's just talk about how big it is. Let's just say a vacation home's $500,000, just to make up a number. 400,000 of that roughly would be improved property. And you can take roughly 30% of that, somewhere between 20 to 35, let's say 30% or a third of that. That's like $130,000 deduction that you can deduct that against your ordinary income. So if you made 150,000 and you got a deduction of 130, you just took your taxable income down to $20,000.
I mean, that's crazy.
Awesome, isn't it?
I was just typing into chat as you were saying that. So let's say that results in $40,000 of net money in your pockets, right?
Yep.
That's $40,000 that you would have otherwise had to send to the IRS. Now that's money back in your pocket that you don't have to pay taxes on. And then if we kind of bring this world together of lowering taxes on active income and eliminating them in the future, if you took that 40K and let's just say you did something so crazy simple, you just put it in a vault, right? The vault then protects and shields your money for the rest of your life while giving you the ability to access and leverage it. If you put the money that one time, $40,000 into a vault and just let it compound for the next 50 years, that's going to turn into $1.1 million, almost $1.2 million over 50 years. And as that money's compounding or growing, you have the ability to access and leverage it all tax free to be able to accomplish other financial goals. I mean, that's how powerful tax strategy is. It's not just what you write today, it's the opportunity cost that had you not written that check, that's money you now get to keep and put to work for you to buy back your freedom. So Scott, with all of this in mind, let's bring it back to where we started. At the end of the day, the passive income machine, the investment strategy that we recommend to people is driven by the tax code. Because the tax code, if you're unaware or uneducated or ignorant, willfully or just by default, you're going to work for your entire life to pay taxes, period. I mean, that's really what it comes down to. You will never actually be free. I mean, imagine going into retirement and biting your fingernails and hoping that the government doesn't raise taxes. I mean, look at what the government is doing. They're either going to tax you directly by raising taxes or they're going to tax you indirectly by printing money and causing inflation. And if you're at their mercy, even if you have enough money, you're nervous and you're scared because you're not in control of the outcome. If, however, you raise your financial intelligence, you use the tax code intelligently, the government is literally putting out those, what did I say, how many pages? They're putting out those 2,600 pages as your treasure map. And as much as it kind of sometimes gives me the icky feeling to think I'm in partnership with the government and the IRS, man, if they're going to use it to incentivize behavior, I'm going to align my behavior to minimize my taxes so I keep more of my money. That's what creates real sovereignty, is when my money is mine in the future and it's not open to someone else coming in saying, hey, tax rates are going up, you lose 30% of your assets.
Yep, absolutely. And in fact, on a personal note, this is how I kind of scaled my portfolio. I took advantage of some of these strategies. I'd have the tax savings, and then I'd have that extra cash and redeploy it. That's what we were talking about with this individual yesterday, is it's a choice, right? You're going to be paying money one way or the other. I mean, you're going to write a check to the IRS for that amount, or I'm going to take advantage of these strategies and end up at the end of the day having some of a nest egg available to put into something, to put it into a vault, to put it into a business. And you've got a choice. Do you just want to blindly write a check? Or do you want to take advantage of these strategies and go, I can now take advantage of X, Y, and Z strategy, or maybe all three, or a combination of them today, and then I'm going to have a little bit of money left over that I can now deploy and begin building my financial future by keeping it. Because, there's that adage, right? It's not what you make. This individual was a high earner. It's what you keep that makes all the difference. And there's nothing more tragic in life, Ryan, and you and I see it all the time, where people work really, really hard. They're hard work. America, we are filled with hard workers, and I don't care whether you're white collar, blue collar, anywhere in between. Americans work hard, no doubt about it. The sad thing is, after all that hard work, because it gets confiscated with taxes, confiscated with inflation, they don't have much to show for it at the end of their life. And that's a tragedy because it's avoidable. And getting something like the passive income machine in place is what can change and take somebody on a trajectory over here, which leads to stress and scarcity and all these things that are not great, or leads to abundance and opportunity and possibilities. So I prefer the latter camp all day long. And I think as we're getting the word out, that's the whole goal, is to show people there is a much better way to reallocate, repurpose, and re-strategize. So we'll take what you got going on now, we'll look at it, and we'll help get you on the path that's towards abundance and optimism and opportunities and possibility and vacations with your grandkids that are just awesome, and living a life that matters with the people you love and care about. That's more important than money, is hanging out with the people you love and care about and sharing good times and experiences and doing that. That's, to me, part of the end goal.
That's it right there, my friends. Well, with that being said, as Scott just said, you have a choice. So make the choice that's going to serve you both now and in the future. Number one, thank you for listening to this podcast and join us on the next episode. All right, my friends, thanks so much for hanging out today. I really appreciate you tuning in. But before you go, if we talked about something today that made you want to take action, you need to get yourself registered for the How to Retire in 10 Years Summit. It's the financial game changer that you've been looking for, teaching you exactly how to create passive income and financial freedom in 2025. Jump on it early because we've got a special bonus waiting for you. All the details are in the link below, or head on over to retireintenyears.com. So get registered and I'll see you at the summit.